3 years ago, I made a decision that cost me exactly $47,318, not in one day, not in one trade, but slowly, quietly. And by the time I realized what was happening, it was too late. This is the story of the $8,000 mistake that changed how I think about money forever. At the time, I was 24. I had just saved my first $20,000. I felt behind in life. Everyone online was talking about investing, real estate, crypto, side hustles, passive income. I didn't want to be average. I wanted leverage. So when I saw an opportunity to invest $8,000 into what looked like a guaranteed short-term rental property deal, I didn't hesitate. A friend of a friend was flipping small vacation properties. He showed screenshots, income projections, occupancy rates, before and after renovations. He said, if you get in now, you'll double your money in 18 months. And here's the worst part, it made sense on paper. I told myself, it's only 8,000. Worst case, I lose some. I wired the money that week. The first 3 months were quiet, no updates. Then I got an email. Unexpected renovation costs. They needed another $3,500 from investors to finish. That's when I made mistake number two. I sent it because I didn't want my first 8,000 to go to waste. That's called the sunk cost fallacy. But I didn't know that yet. 6 months later, the problems stacked up. Property taxes were higher than expected. Insurance doubled. Interest rates rose. Bookings were lower than projected. The property wasn't cash flowing. It was bleeding. Instead of doubling in 18 months, it was losing money every single month. Then the market cooled and they had to sell at a loss. Here's what it actually cost me. Initial investment $8,000, second injection $3,500, legal and administrative fees $1,200, total in $12,700. Returned to me after liquidation $5,382. Direct loss $7,318. But that's not the real number. If I had invested that same $12,700 into a basic index fund returning 8% annually for 20 years, it would be worth over $59,000. The opportunity cost alone, $47,318. That's the real price of that decision. The worst part wasn't the money. It was the ego. I wanted to feel smart, early, ahead. Instead, I learned something expensive. Most fast money stories are built on optimistic spreadsheets, not durable fundamentals. So here's the first quiet capital lesson. If someone promises fast returns, ask yourself, what assumptions does this require? What has to go perfectly? And what happens if it doesn't? Real wealth grows quietly, slowly, boringly. Speculation is loud. Capital preservation is silent. And silence compounds. That $8,000 mistake didn't make me poorer. It made me patient, and patience is the foundation of quiet capital.